Did you know that understanding cap rates could be the difference between making a fortune and losing your shirt in commercial real estate? Yeah, it's that important. In today's video, we're diving deep into the world of cap rates. We'll uncover what they are, why they're crucial for your investments, and how you can calculate them like a pro. Whether you're a seasoned investor or just getting started, understanding cap rates is key to making smart, profitable decisions in commercial real estate. So grab your notebook and let's get started. So imagine you're buying a goose that lays golden eggs. You want to know how many golden eggs you're going to get for the price you pay, right? In the world of commercial real estate, that goose is your property. The golden eggs are your income, and the cap rate, well, that's the magic number that tells you how good of a deal you're getting. A cap rate, short for capitalization rate, is like the heartbeat of a property. It's a simple ratio that compares the net operating income, that's all the money you make from the property after expenses, to the property's current market value. Here's the formula. Cap rate equals the net operating income divided by the property value. Easy, right? But why should you care about cap rate? Well, think of them as your trusty GPS in the wild world of real estate investment. They help you figure out if a property is worth your hard-earned cash. Higher cap rate, more income for less investment. Lower cap rate, it might be safer, but potentially pricier bet. But wait, there's more. Cap rates aren't one size fits all. Different types of properties have different typical ranges. Office buildings, retail buildings, apartment buildings, and industrial buildings all can have cap rates that are usually in the range anywhere between 5 to 10%. Depending on what part of the economic cycle we're in and what current interest rates are. Know that comparing an apartment building with a 6% cap rate is not an apples to apples comparison to a retail building with a 6% cap rate. Different asset or property types and risk profiles also play into this comparison. Knowing who your property management company is and how successful they are at leasing, as well as how creditworthy a tenant is for a retail building, all play into the risk profile of an investment. All right, let's break down the two main ingredients of a cap rate: the net operating income, or NOI is the acronym, and the property's current market value. Sounds fancy, right? But don't worry, it's simpler than it sounds. First up, we have the NOI. Now, what exactly is the net operating income? Well, it's basically the income a property generates after you've paid all of the necessary operating expenses. Think of it as the cash left over after you've covered things like maintenance, insurance, property management fees, and those pesky utility bills. It's like your property's profit before you start paying off any debt or taxes. Simple enough, right? The formula is NOI equals the total revenue minus the operating expenses. So here's how you calculate it. Take your total revenue from the property. This could be rent from tenants, parking fees, or even those laundry machine quarters, and subtract all of your operating expenses. Boom, you've got your NOI. Let's say your property brings in $100,000 in revenue annually, and your operating expenses total $30,000 annually. Your NOI would be, drumroll please, $70,000. Not too shabby, right? Next, let's talk about the property's current market value. This is basically what your property would sell for in today's market. It's like checking the price of your favorite sneaker on eBay. The market value can fluctuate based on location, demand, condition of the property, and a bunch of other factors. So it's always good to keep an eye on the market trends. Why is this important for our cap rate calculation? Because the cap rate formula is all about the relationship between your NOI and your property's market value. It's like figuring out the return on investment for your property. If you bought that sneaker for $100 and it's now worth $150, you'd want to know what kind of return you're getting, right? So to find your cap rate, you simply divide your NOI by the property's market value. Let's stick with our example. If your NOI is $70,000 and your property is worth $1 million, your cap rate would be 7%. Not bad, huh? Remember, a higher cap rate typically indicates a higher return on investment, but it can also mean higher risk. It's all about finding that sweet spot that works for you. Now let's talk about common pitfalls and mistakes to avoid when calculating cap rates. Mistake number 1, using gross income instead of net operating income. Gross income is all the money your property brings in before expenses. But we all know nothing in life is free, especially not property maintenance and taxes. Always use the NOI, which is your income after expenses, to get an accurate cap rate. Mistake number 2, ignoring vacancy rates. It's great to be optimistic, but assuming your property will always be 100% occupied is like assuming your cat will never knock over your favorite mug. Factor in vacancy rates to avoid overestimating your NOI. Lastly, mistake number 3, not updating the property value. The market is a roller coaster and property values can change faster than you can say real estate. Make sure you're using the current market value, not the price you paid back in the day when gas was $1 a gallon. Now let's talk about factors affecting cap rate. Think of cap rates like a roller coaster. Thrilling, a bit unpredictable, but totally worth understanding. When the market is booming, cap rates tend to shrink. Why? Because everyone and their grandma wants a piece of that sweet real estate pie, driving property values up. Conversely, when the market's a bit gloomy, cap rates rise as property values drop and potential investors start clutching their wallets a bit tighter. So remember, the state of the economy plays a huge role in determining cap rates. Next, let's talk property types. Not all properties are created equal, and cap rates definitely reflect that. Office spaces, retail stores, industrial warehouses, they each have their own cap rate personality. For instance, office buildings in bustling downtown areas might sport lower cap rates because they're in a high demand and perceived as stable investments. Meanwhile, industrial properties might have higher cap rates due to their location or specific use cases. Think of it like dating profiles. Each property type has its own unique attributes and appeal to different investors. Now, onto location. You've probably heard the phrase location, location, location a million times, and for good reason. Location is a major player in the cap rate game. Properties in prime locations with strong economic activity, like major metropolitan areas, tend to have lower cap rates. On the flip side, properties in less desirable or emerging markets often have higher cap rates. It's kind of like real estate's way of saying you gotta pay to play in the hot spots. So always consider the zip code when evaluating cap rates. Last but certainly not least, let's talk about cap rates are like a risk barometer for investors. Properties that are considered high risk, maybe they're in an unstable neighborhood or the building needs major repairs, usually come with higher cap rates. This is because investors expect a higher return for taking on more risk. Conversely, properties with rock solid stability and reliable income streams will have lower cap rates because they're seen as safer bets. So when evaluating a property, always ask yourself, how risky is this investment? The answer will help you understand the cap rate. Now let's cover advanced considerations in regards to cap rates. First up, future income projections. Imagine you've got a crystal ball. Okay, maybe not a crystal ball, but close enough. Future income expectations are like your investment's forecast. If you expect the property's income to rise, guess what? The cap rate might look pretty sweet. It's like planning your vacation wardrobe based on weather forecasts. You pack for sunshine and you'll have a great time. Let's break it down. If a property is expected to generate higher income in the future, investors might accept a lower cap rate today. Why? Because they're banking on that future cash flow. It's like accepting a smaller slice of cake now because you know there's a bigger, tastier one waiting for you later. Next up, interest rates. The love-hate relationship we all have with interest rates. When interest rates go up, cap rates tend to follow. It's like a dance, a rather unromantic one, but a dance nonetheless. Higher interest rates mean higher borrowing costs, which can squeeze your return. So investors demand higher cap rates to compensate. Think of it as needing more frosting on your cupcake to balance out the bitter coffee you're having with it. Now let's talk market cycles. Real estate markets are like roller coasters. They have their ups and their downs. During boom times, cap rates might compress because everyone's optimistic and willing to pay more. During downturns, cap rates expand as caution takes over and prices drop. It's all about timing. Buy low, sell high, the age-old mantra. Understanding where we are in the market cycle can help you make savvy investment decisions. It's like knowing when to get on and off the roller coaster to avoid that stomach-churning drop. All right, folks, we've covered a lot today about cap rates and commercial real estate. So let's do a quick recap to make sure we're all on the same page. We started with the basics. What exactly is a cap rate? Remember, it's the rate of return on a real estate investment property based on the income that property is expected to generate. Think of it as the shorthand for how quickly you're getting your money back. Then we broke it down into the two main components: net operating income, or NOI, and property value. The cap rate formula is pretty straightforward. Cap rate equals the NOI divided by the property's value. Simple, right? We also highlighted some common mistakes, like forgetting to include all operating expenses in your NOI calculation or using outdated property values. Trust me, these mistakes can throw off your whole analysis. Next, we looked at factors that can affect cap rates, such as market conditions, property type, location, and perceived risk. Just like the weather, cap rates can change depending on where you are and what's happening around you. Lastly, we talked about the relationship between cap rates and interest rates. Spoiler alert, when interest rates go up, cap rates often follow. It's like a dance between the two. If you found this video helpful, make sure to give it a thumbs up and hit the subscribe button for more expert insights on commercial real estate. And hey, don't be shy. Drop a comment below with your experiences or questions about cap rates. Have you encountered any tricky situations? Or maybe you've got a tip or two to share? I'd love to hear from you. Thanks for watching, and I'll see you in the next video. Stay savvy, real estate investors.